Hello and welcome to the lecture for part 1 of chapter 8. In this chapter we're going to look at different kinds of ways to structure the ownership in an organization. There's three primary categories. The first is sole proprietorships, which I'll talk about that in more detail. It's basically a person owning a business individually. Another would be partnerships, which is groups of people, and then corporations, which are also groups of people, but a different form from a legal perspective. So I'll talk about kind of the attributes and pros and cons of each of those three different categories. And then because corporations reflect the majority of entities, and from a revenue perspective, we'll go into greater detail about corporations. We'll talk about capital stock, common versus preferred, and then I'll talk about classes of stock and financial reporting, treasury stock, and we'll talk about how corporations pay dividends to their owners and how they appropriate retained earnings and investment decisions. So first, sole proprietorships. These are the most common by number of organizations. So there's a lot of very small sole proprietorships around the country. Think of mom and pop businesses or people operating out of the garage, that sort of thing. They're very simple to form, so there aren't you don't need to involve a lawyer. There aren't any difficult papers to submit or anything like that. It's really just depending upon the field that you're entering, there may be some licensing requirements, and technically you should be registered with the state as a business. The biggest problem is there is no limitation on legal liability. So I put the biggest downside or red flag in red on each of these slides. What that means is that there's no division between the business as a legal entity and you as an individual. So the debts of the business are your debts personally, period. Where that comes into play is when things go wrong. So think about it, say as an example that maybe I work on cars on the weekend, which is totally not true. And so I have a business, people pay me and I change their oil and I do different maintenance tasks on their car, small repairs, and I charge them and they pay me. And I'm a sole proprietor. I didn't incorporate, I'm not part of a partnership, so there's no legal entity separate from me personally that is doing this work. So what if I forget to attach somebody's brake lines and they leave and crash their car and damage other cars and injure themselves and all of that? Well, that was clearly my fault. They can sue me for that. The problem here is that they can not only take the assets of my business, they can take my personal assets. So they can take my retirement account, they can take savings that I have in the bank, all of that can be at risk over the activity of that business. That's what makes sole proprietorships a very dangerous form of business to go into or to adopt because of that lack of a limitation on legal liability. So it's not taxable unto itself, meaning that the revenues and expenses of a sole proprietorship flow onto the owner's personal tax return on a Schedule C. It has a limited life in terms of when the owner dies, the business dies, it doesn't continue on. You can't pass a sole proprietorship on to your children, as an example. And that causes it to have a limited ability to raise capital. So if you're thinking of starting a business that needs a lot of capital, like maybe you've got an idea for an all-electric pickup truck, well, that requires factories and all kinds of equipment and all that kind of thing. It would be very difficult to raise that in a sole proprietorship. Basically, the only source of capital is the owner. Partnership. Partnerships involve two or more people that together are trying to earn a profit. That's the definition of a partnership. And it can arise informally. So you and a couple of friends could say, hey, let's go in together, let's pool our resources and buy Seahawks season tickets so that we can resell them on the open market and make a profit. Well, even though you might not have a legal agreement, you might not be formally recognized by the government as being a partnership, but you are in effect a partnership and you would be treated as such in a court of law. So that's something to be aware of. Partnerships are more complex to form certainly than a sole proprietorship. And partnerships generally have what's called a partnership agreement. And here is where an attorney can be helpful in terms of saying, well, make sure you include this, include that, and so forth, all the different provisions. Basically, a partnership agreement is going to answer the types of questions like, what are each of the partners contributing in return for their ownership share? What kind of work are each of the partners doing for the partnership? Is somebody a silent partner that only contributed money and is not expected to do any work? What is the agreement in that regard? What's the agreement about splitting profits or funding losses? So what are the requirements there? Are there any restrictions on partners taking money out of the partnership? Are there limitations to that? What about new members? Can somebody leave the partnership and sell their partnership interest to somebody else? Do the existing partners have to approve that, or can it be done unilaterally? So, and then how do they break up? Like, how do they decide that this business should no longer go forward, and how do they split up what remains? So those are all the kinds of questions that should be discussed and documented and signed off on before you ever start. And again, the benefit to that activity is that it's less likely for significant disagreements to come up later. Anytime, especially if you go into a partnership with friends, mixing friends and business can be tricky. And so I can't recommend strongly enough the importance of having a partnership agreement. If it's done well, the best agreements never come out of the desk drawer, because you don't need to reference them, because everybody knows what the ground rules are because they participated in writing them. So that's important. Like sole proprietorships, partnerships have no limitation on legal liability, and that legal liability is joint and several, meaning if you enter into a partnership with two other people, and that partnership suffers losses and racks up large debts and decides that they're going to end things, the people to whom you owe money can come to any one of you personally and take your money to satisfy that debt. And if you have two partners that are very poor or destitute and one partner that's wealthy, they can cover all of the partnership's debts from that one wealthy partner. So any individual partner, regardless of their ownership interest, is on the hook for all of the liabilities of the partnership. That's a really big downside. So if somebody flatters you by offering you a partnership, think about that, because you could end up on the hook for something that you didn't anticipate. Then it's up to that partner to then go after the other partners to get their share, but that's separate from the legal judgment for a debt, as an example. Partnerships also are not taxable, meaning their income flows through to the partners, and the partners have to pay tax on their share of the partnership income. They also have a limited life. Technically, when one partner leaves or another partner joins, that one partnership is ended and a new one is started. Because of that limitation on legal liability, it can be difficult to talk people into joining a partnership, which is how they generally raise capital. All of the property that's contributed to a partnership, say that me and two of you start a partnership to fix cars, just to continue with that example, and I contribute a bunch of tools and a cherry picker, well, that equipment is now partnership property. So if we break up, I just can't take my stuff and go home. It's not my property any longer. Mutual agency means that any partner can obligate the partnership. So again, you have to be very careful about the people you choose to become partners with, because they can make decisions that you're then on the hook for. And the one positive thing, and I kind of trash partnerships here, but one positive thing is synergy. The fact that 1 + 1 + 1 can equal 5. That together you can be greater than the sum of your parts. So that's a big deal, and it allows you to participate in that income. So there are times and places for partnerships for sure, and I've been in partnerships with people before. But again, the key thing is to make sure that you document everything in advance and be aware of the downsides. So corporations represent the largest amount of U.S. business in terms of revenue. So all of the big companies that you think of, Apple, Ford Motor Company, Tesla, all of those companies are corporations. Until I started teaching, every organization I worked for in my life was a corporation. So corporations are a separate legal entity. They can buy and sell assets. They can incur liabilities in their own name. They can be sued. They can sue other people or other corporations. And the key difference is they can sell shares of ownership called stock. So it is the stockholders of a company that own and control the company. And it's basically one vote per share, unless you get into more complicated versions of that. So public corporations sell their stock on public exchanges. So the companies I mentioned before, Apple, Tesla, Ford, those companies offer their shares for sale on the New York Stock Exchange, on NASDAQ. They're publicly traded companies. They can issue stock and raise large amounts of capital, which they can use to buy factories, buy other companies, invest in research and development, all of the things that are needed to grow those companies. That's in many ways how they got very large. I would compare that with private corporations or closely held corporations that are owned by a small group of people or even one person. When I owned Big Toys, my wife and I owned 100% of the stock. We were a closely held corporation. So we were a corporation with stock, with shares of ownership, but it wasn't bought and sold on public exchanges. If you wanted to buy a share of my company, that wasn't available to you because we owned all of them. We could have chosen to have sold those to people, but we didn't. So a corporation is a separate taxable entity. So its net income is subject to state and federal taxes. That gives way to the one big downside of corporations, which is double taxation. So if you have a corporation and it earns $100,000 in net income, you'll be taxed at a rate now currently is 21%. So you'll pay $21,000 to the federal government for income tax for that corporation. The $79,000 that's left in the corporation could be distributed to owners as a reward for their ownership. When those owners receive those dividend payments, that amount is taxable to those recipients. So the income is taxed 2 times. That's the big downside to corporations. The big upside to corporations is that there is that separation between your personal life and your business life. That was one of the reasons when my wife and I owned Big Toys that we insisted that it be a corporation, because we didn't want somebody that fell off a playground and decided to sue us to be able to come after our personal assets. We wanted kind of a firewall between our business assets and our personal assets. The big advantage to corporations, in addition to that separation of personal and business liability, is the ability to raise capital, to bring in money that is not debt to help fund the corporation. So the hierarchy in corporations, as I mentioned, stockholders elect a board of directors, and generally it is 1 vote per 1 share. So somebody that owns a majority of the shares in a company can determine who the board of directors is. The board of directors is going to answer the big questions in the company. What kind of business should we be in? Should we acquire competitors? Should we sell on the internet versus sell through stores? Should we, or do both? Those kinds of big strategic decisions are generally made by the board of directors. So they should, and board of directors will run for election at a shareholders meeting. They'll say, this is what I think the business should do. And shareholders can say, I agree with that person, and they can place their vote for that individual to be on the board of directors. The board of directors, and it could be 5 people, it could be 12 to 15 people, it can vary in size. Those are generally people that have a lot of business experience that serve on boards, and again, deal with those bigger questions. They're the ones that hire and appoint the CEO, the chief operating officer, the chief technology officer. Those kinds of positions in the company generally report to the board of directors. So the board of directors is going to hire the president or CEO of the company and can fire them as well. So the top person in the corporation has a boss. It's the board of directors. The top management of the company, the officers of a company, sometimes it's called the C-suite because they all start with the word chief. They're the ones that then hire managers and supervisors and all of the other employees in the company. But that's the basic hierarchy. So in forming a corporation, it's done by state, and you don't need to incorporate in the state in which you're located. I worked for several corporations located here in Washington State, but we incorporated in Delaware because Delaware has more favorable laws for corporations. There are actually more corporations incorporated in Delaware than there are citizens in Delaware. The state, once they receive your application and a small fee, they grant an article of incorporation. That's a document that shows that your corporation exists legally, and that in banks would ask for a copy of that document if you're opening bank accounts in the corporation's name. Other kinds of entities will ask for that information. So the first step then is for the board to meet and adopt a set of bylaws, and that's going to govern how the corporation is managed. What kind of questions need to be addressed at the board level? How often does the board meet? What is the makeup of the board? How are board elections handled? All of those kinds of things will be dealt with in the bylaws of the corporation. So paid-in capital is money that comes into the company in return for issuing shares of ownership called stock. And we've dealt with a couple of different transaction grids where we've had money coming in that way. And there's three different kind of levels of shares of stock. So there's the amount that's authorized. That's what the board of directors will say in the bylaws. Okay, management, we want you to raise money to start building this company. You're authorized to issue up to, and they'll pick a number. Maybe it's 1 million shares of stock or whatever the case is. So that's not saying that management should run out and do that right now, but they can go up to that level without having to come back and ask for permission to do more. A subset of that number then, maybe that's 1 million, a subset would be the amount that's actually been issued. So of course it's done electronically now, but in the old days it was an actual book of stock certificates. So to issue a share of stock, you would write the individual's name on the certificate, they would give you cash, and you would give them the certificate and keep a stub so you knew who owned which shares. Again, it's done electronically now, not manually, but thinking about how it's done manually can help you kind of visualize shares that have been issued. A smaller subset could be the amount that's outstanding, and the difference between how many have been issued, meaning given to shareholders in their hands, versus how many are outstanding would be if the company bought some shares back. And we'll talk about that in the next lecture, treasury stock. So that'd be the difference between those two. Most states allow for a par value or require either a par or stated value associated with the stock. That is to protect creditors. So the company has a what's called legal capital. They can't return funds to the shareholders below that level. And a couple of things about the rights of shareholders. One, they have a right to vote on corporate matters by electing the board of directors. They have a right to a share in profits, and they have a right to a share of assets if the corporation is liquidated or sold. Okay, I will talk to you again in part 2 of this lecture. Thank you.